Well, good morning, everybody, for the last of the IFS webinars this year, and the last of the pieces of work we'll be doing this year directly about the impact of COVID on household finances and other things. Today, I'm delighted to introduce several pieces of work, all based on one very novel, very interesting data set, which you'll hear more about from my colleagues, which essentially looks at the use that people are making of their bank accounts and how that's changed over the period of the last year. I'd like to thank particularly the Standard Life Foundation for funding this work, and also Trust for London for funding some of the work which you'll see, which is directly looking at things that have been happening in London. We've got two speakers today. The first, my colleague Isaac Delestre, who will be talking in particular about the impact of policy over this crisis and what we can see from this data about the impact of the furlough scheme, the self-employment income support scheme, and so on. And then secondly, Alex Davenport will be looking more broadly at what we can tell from this data, particularly about spending patterns. And as you'll have hopefully seen today, this morning's report looking at how those have changed over time and across the country, where I think we found some really dramatic and interesting results. So without further ado, I'll hand over to Isaac. But before I do, please, if you do have any questions, we have the Slido app open, which you can put your questions in or indeed vote for other people's, and we'll have hopefully a good half hour for questions after Isaac and Alex have spoken. So it's enough for me, and I'll hand over directly to Alex.
Yeah, thank you very much, Paul. So I'm going to start off, as Paul said, talking a little bit about the trends we've seen in household finances across the crisis, and particularly how those have interfaced with some of the more novel income support programs pursued by the government over this period. So I want to start off just by talking to you a bit about the data that we've been using for this project. So the data is derived from an app called Money Dashboard. Money Dashboard is a budgeting app. It works by users linking in their bank accounts to the app, and then the app labels their various transactions into different categories. So it might label one transaction as groceries, another as salary, etc., etc. The data that we have access to is an anonymized transaction level data set derived from Money Dashboard. So we essentially see all transactions taking place in bank accounts that are linked to Money Dashboard. And we also have some basic demographic information about Money Dashboard users. Now, a very natural concern with any data set like this is that clearly we're not dealing with a random sample of the population. And so we've done some quite careful work thinking about how representative this data set is of the wider population. And what we found is that the Money Dashboard user base tends to be younger, and it also tends to be somewhat more southern than the wider population. But we've also found that by making a few relatively simple adjustments in terms of age and region, we're able to create a data set that's really quite representative of the wider UK population, particularly on metrics like income. Okay, so now I've introduced you to what the data is, I want to tell you a little bit about what it can tell us about how household incomes and earnings have evolved, particularly over the first part of the crisis. So what I'm showing you here is the change in median real household earnings between January and May 2020. And on the right, you're seeing that measure for the households that had the highest incomes prior to the crisis. And on the left, those households that had the lowest incomes prior to the crisis. And what you can see very clearly from this chart straight away is that it's those households that had the lowest incomes prior to the crisis that saw the biggest hit to their earnings during the crisis. Now, the line I've just added to this chart is a similar measure, but this time for income rather than earnings. And the key distinction between income and earnings in this context is that income includes benefits, whereas earnings does not. And so what we can see is that once benefits are included, it's actually no longer the case that those who had the lowest incomes prior to the crisis take the biggest hit during this early part of the crisis. And I think what this emphasises and what this should show us is just the very important role that government support has played in terms of the development of household finances across this period. Okay, so for the remainder of the presentation, I'm going to be focusing in on three particular groups that we've identified in our data that relate to some of the policies that the government has pursued in order to support people's incomes in this period. So the first group that we're able to identify in the data are furloughed workers, so beneficiaries of the Coronavirus Job Retention Scheme, or CJRS. These are individuals whose incomes, or whose salaries rather, we see falling to 80% of their pre-crisis level. So we'll not be considering workers whose salaries were topped up to 100% by their employers, which has been the case with some furloughed workers. We're also going to be looking at a group of individuals, of households rather, who benefited from the Self-Employment Income Support Scheme. This is the scheme that's essentially analogous to furlough for self-employed workers. Those who receive support through the scheme get a grant worth 80% of their pre-pandemic trading profits. Now, it's worth highlighting at this point just that not every self-employed individual has received support through this scheme. There are some important groups who haven't been able to access support through the scheme, but for the purpose of our analysis here, we're just going to be looking at those who did receive payments. And the final group that we're going to be looking at is a group of universal credit claimants, people receiving a universal credit payment for the first time during the crisis. Now, obviously, universal credit is a benefit that predates the coronavirus crisis, but what I'm showing you on this chart is the daily universal credit applications in March and April. And as you can see, this early part of the crisis, the back end of March and beginning of April, really saw an explosion in the number of people moving on to universal credit. Okay, so just in order to provide you with a bit of context about these three groups, I want to talk a little bit about how their incomes evolved over these first 3 months of the crisis. And first, I'm going to show you how their incomes changed between January and May 2020 when you include the government support they received. So including government support, the furlough group see around a 15% reduction in household income. Universal credit group around a 40% reduction, so a much larger reduction. And the SICE group, the Self-Employment Income Support Scheme group, see almost no reduction in their income when you include government support. So that support was sufficient to mitigate any fall in income they would have seen otherwise. Now, the next thing I'm showing you here is the same measure for the same people, but excluding any government support they received. So if we strip out the government support they received, how would their income have changed? For the furlough group and for the universal credit group, they both would have seen very large falls in their income, around 60%, around a 60% fall in household income. One thing just to note here is that clearly without support, these two groups would have seen similar falls in income. The fact that with support, the furlough group sees a much smaller fall in income speaks to the fact that the furlough scheme is just much more generous than the universal credit scheme. And finally, the SICE recipients without support would have seen around a 30% fall in their income in this period. Okay, so we've seen that the many groups are receiving quite substantial income support during this period, but it's also clearly what we also clearly see in the data is that this is also a period of quite acute financial distress for many households. And one of the quite interesting ways that we can get at that using this data is to look at the share of households that were making regular bill payments prior to the crisis occurring, and to see whether those households cease making bill payments during the crisis. So what I'm showing you here is the change in the share of households making utility bill payments between January and May. And what we can see is that for the 40% of households that had the lowest incomes prior to the crisis, there are actually quite substantial reductions in the share of households making regular utility bill payments, which could easily be indicative here of some quite acute financial distress being undergone by those kinds of households. Now, for council tax, we see also large falls in the share of households making council tax payments, but in this case, we see them somewhat more uniformly across the income distribution. And the same is also true for mortgage payments, where we see falls in the share of households making mortgage payments all across the income distribution. So what I'm going to be focusing on now is going to be thinking about how the government policy income support programs that have been put in place have helped households to bridge these periods of financial distress, how successful they've been in doing that, and in some cases where they haven't been successful in doing that. Okay, so the chart I'm showing you here is showing you the share of households in our furloughed group, in our group of furloughed households, making mortgage payments in a given month, and that's indexed to 100 for the pre-crisis period. Now, we're comparing our furloughed group here with a control group. That control group consists of Money Dashboard users who look similar to the furloughed group prior to the crisis, so they have a similar income and spending profile, but who don't see a hit to their income during the crisis. So we can broadly think of this group as representing the path that the furloughed group would have followed had they not seen a hit to their income. And we develop these kinds of control groups for all three of our policies. And the purpose of them is just to be able to separate out the effects that are occurring to the whole population during the pandemic and effects that are specific to our individual groups. So what we can see here is that even the control group, the group that didn't see a hit to their income, do see a reduction in the share of households making mortgage payments in this early part of the crisis. The important context to place that in is that mortgage holidays have been made much more readily available by the government during this period. So it seems that even some households who haven't seen a hit to their income have taken up these newly available mortgage holidays. We also see clearly here that there does seem to be a larger reduction in the share of households making mortgage payments amongst the furloughed group, although it's by no means a huge fall, and we'll see it's a much smaller fall than for some other groups. Okay, so the next thing I'm showing you here is I'm showing you weekly consumer expenditure for the furloughed group across this period. And what we can see straight away is that during the early part of the crisis, consumer expenditure falls quite sharply, both for the control group and the furlough group. That's to be expected. This is the period covered by the first national lockdown. Many shops are closed. There's just a lot less for people to spend their money on during this period. But we can also see quite clearly that expenditure for the furlough group falls considerably more than it does for the control group. So that fall in income that the furlough group have seen quite clearly does seem to feed through here into reduced expenditure and therefore reduced living standards during this period. What I'm showing you now is our universal credit group. And again, I'm showing you the share of households that are making a mortgage payment in a given month. And if you look at the horizontal axis here, month 0 is the month that begins on the day when universal credit recipients receive their first universal credit payment. And that's going to be a different date for different households. Now, the first thing just to notice here is that universal credit groups see really a very, very large reduction in the share of households making a mortgage payment. In fact, we see a halving of the share of households making mortgage payments over this period, so much, much larger than for the furlough group. The second thing just to draw your attention to here is the timing of that fall. So the vast majority of the drop-off in the share of households making mortgage payments appears to occur in the month prior to the first universal credit payment being received, which is the vertical line here. Now, the reason that's so relevant for this policy in particular is that the design of universal credit is such that there's an inbuilt 5-week wait between the period where an individual applies for universal credit and the point where they actually receive their first payment. And it seems like this waiting period is associated with significant enough financial distress for many households that they feel the need to access emergency liquidity by taking out a mortgage holiday. Okay, so in the next chart I'm showing you is once again weekly consumer expenditure for our universal credit group. And as for the furlough group, we see that the universal credit group's expenditure falls by more than the control group. So we're seeing that this fall in income feeds through to a fall in expenditure. But one thing we also see here is we're starting to see some more tentative evidence of the real importance that the waiting period for support to arrive has for individuals. So if we look here, we can see in the several weeks that precede the first universal credit payment arriving, the gap between the expenditure of the control group and the universal credit group is at its widest. At this point, it's 9 percentage points. By the time we arrive at the 8 weeks after the first payment has been made, that's narrowed to just 5 percentage points. So what we're seeing here is early and sort of maybe relatively tentative evidence that the timing with which these support programs are administered really matters. This waiting period before payments arrive seems to be associated with a particular suppression of expenditure amongst recipient households. Now we're going to see some much stronger evidence now reinforcing this notion of how much waiting periods seem to matter in terms of how income support programs are administered. And we're going to see that for our self-employment income support scheme group. The reason this is going to be so relevant for this group is there's actually a 2-month wait between the beginning of the crisis and this group receiving their first support payment on the 18th of May. And that's just because this was a brand new scheme which had to be designed from scratch by the Treasury. What we see quite clearly here is that in the first few months of the crisis, and again, what we're looking at here is the share of households in our group making mortgage payments in a given month. And rather than comparing with a control group here, we're comparing with the same group in the previous year. What we can see quite clearly is that there's a large fall in the share of households making mortgage payments prior to the SICE payment being administered. And so quite clearly, it seems to be that this period of waiting for benefits to arrive, waiting for income support to arrive, is associated with acute financial distress, which some households are responding to by seeking out emergency credit through a mortgage holiday. We see that once again in the expenditure profile of this group. So if we see in the initial weeks of the crisis, the SICE recipients see a large fall in their expenditure, very precipitous narrowing of the gap between the control group and the SICE group, sufficient such that, in fact, the SICE group rejoin the spending path we'd have expected them to follow had they not seen a hit to their income at all. So again, it seems like this waiting period is very specifically associated with suppressed consumption and suppressed living standards for affected households. So I just want to come to a few brief conclusions now. Firstly, it seems very clear that the differing designs of these three policies seem to filter through very clearly into the expenditure patterns of households and into their living standards across this pandemic. Secondly, it's very clear that timing of support appears to be quite crucial. These waiting periods, as we've seen, seem to be associated with particular financial difficulty for households and particular periods of suppressed consumption and missed bill payments. And finally, we see that one of the first levers that households seem to pull during these periods of financial distress is to cease making mortgage payments, so to take advantage of mortgage holidays. And I think one of the reasons that maybe should potentially concern us, one of the reasons it's an interesting trend, is that, of course, accessing emergency credit through a mortgage holiday is not an option that every household has. In fact, mortgages are disproportionately concentrated amongst wealthier households. So that's going to be all from me. I'm now going to hand you over to my colleague, Alex, who's going to speak a little bit more about the broader picture of expenditures over this period.
Hi, so yeah, thanks for that, Isaac. So, so as Isaac said, I'm going to talk about spending rather than the income and policy side. So for this, it's using the same data that Isaac outlined, so I don't need to explain the data again, other than to say that basically we get, so the transaction data that Main Dashboard gives us tags transactions to fit certain spending categories. And so that allows us to disaggregate spending in different parts of the economy, as well as looking at total spending. So to look at what we're going to do, why does consumption matter? Why do the consumer spending patterns matter? Well, in a normal year, consumer spending patterns would be very interesting, but in 2020, This is a particularly extreme year, and there's been lots of changes that have been induced by policy and the pandemic that could have dramatically affected consumer spending. So people may have stopped spending in certain areas because they were scared of the virus, because they were told not to do so by the policy response, or because their income has changed, which has forced them to adjust their spending. So in this talk, I'm going to look at the general aggregate changes in consumer spending and across different parts of the economy. So this is important for both for kind of jobs and how the economy is recovering from the pandemic, and also in terms of what might happen in the future, how the economy might look going forwards based on how these spending changes have been brought about. We're also going to look at differences across nations and regions in consumer spending. So this will be important both for kind of geographical inequality in consumption, but also the policy response. If certain areas are doing worse than others, they might need more targeted support to help get through this crisis. We then also look at how spending is related to COVID-19 prevalence. So this is whether an area with hit worse by the virus, does that see lower spending, or does it not really have much of an impact? And then related to that, how do local restrictions impact spending as well? So if an area goes into tier 3 or tier 2, or we have a national lockdown or a circuit breaker, what impact does that have on spending? And then that could help guide how governments may target support, what support might be offered to areas impacted by restrictions. Then finally, we also look at how spending changes could have driven changes in savings. So the idea that households were forced to cut back on spending, and so may have increased saving purely because of the closures in the economy. So beginning with total spending. So this is using the money dashboard data, and yellow line shows spending in 2019 in each week, and the blue line in 2020, with the red lines indicating key policy changes, mostly for England, since that's where most of the sample comes from. So we can see that before the lockdown began, spending was very similar in 2020 to 2019. However, as soon as the first national lockdown began, spending in 2020 plummeted by over a quarter, from £240 per user, which we take as a household per week, to around £180 or even less. It gradually recovered through May and June a little bit, perhaps as restrictions began to ease and businesses and consumers began to adapt to the restrictions. However, it remained considerably below, although it did jump once non-essential retail and hospitality began to reopen. For much of the summer months, spending was around 5 to 10% below normal levels. So although the economy did recover dramatically from the lockdown, it remained subdued. And this has basically continued. However, what's interesting to note is that the second national lockdown appears to have had a much less dramatic impact on spending as the first one. Spending maybe fell very slightly in the early weeks of it, but in general, there was no difference to what was happening before the second national lockdown. This perhaps suggests that consumers and businesses have adjusted quite a lot now. Consumers might spend more online, businesses are more able to serve online, restaurants now offer takeaway services or delivery services. And so there's perhaps evidence that the second lockdown had much less of an impact, which is probably encouraging going forwards for jobs in the economy. So looking in within this a bit more, disaggregating how spending patterns have changed in different areas of the economy, we see that grocery spending in particular is much higher even after an initial period of stockpiling that's clearly visible ends. So this stockpiling, where spending rose to around £80 per user per week compared to about £50 normally, can very clearly be seen. But even after that, spending fell back down a bit, but remains up more than a fifth on normal years. And this has persisted even as restaurants have reopened, as non-essential retail's reopened. And there's perhaps some evidence that there was a slight uptick in this as we went towards the second English lockdown. But in general, there's clearly a persistent increase in spending on groceries. So this chart here is slightly different to the previous ones in that it shows the change year on year from 2020 relative to 2019. If a line is above zero, so the darker line, thicker line in the middle, then that means that spending has risen year on year. If it's below, that means spending has fallen year on year. And this shows spending from the hospitality sector on that. So you can see that before the pandemic, it was very similar. It began falling even before the national lockdown as people avoided hospitality venues for fear of catching the virus, but then plummeted to more than 80% down on normal levels. So this was clearly one of the most dramatically affected sectors. It recovered once hospitality reopened, and in August actually came very close to previous levels. And bear in mind here, we only see the consumer side of transactions. So when the Eat Out to Help Out scheme was in operation, hospitality venues would actually be receiving more than we see here, but the consumers would be paying what we see here because the government was subsidizing these meals. However, as the virus began to resurge, spending in this area kind of declined again, and then you can see quite a dramatic fall in the second English lockdown. But importantly, it's less dramatic than in the first English lockdown. Partially, this is probably because spending in Scotland and Wales could have continued to rise as hospitality actually reopened in those areas in November. But it's also possibly reflective of restaurants offering more takeaway services. But these would still be picked up as restaurant spending if the restaurant was previously mainly a restaurant. So We also can see what happened to takeaway spending here, which is kind of the mirror image of the hospitality sector. Spending began to rise during the lockdown, up 60 to 80% on previous years, and it stayed at this elevated level since. This is despite the hospitality sector reopening, and so it's clear that there's been a very persistent shift towards takeaways. Interestingly, if you look within age groups, it's actually the oldest age groups that have seen the biggest rise in takeaway spending. These groups may have originally been less familiar with takeaway food as opposed to eating in a restaurant, and so they may have got used to this, and this may be a persistent shift that we see. Looking then at another way in which spending patterns have changed, we see that spending's moved from in-store or with cash to online. So cash withdrawals, which is what we're measuring with this line, were already declining year on year, down about 20% in 2020 on 2019. But once the lockdown began and cash use became discouraged and non-essential retail was closed, it plummeted by 80% compared to last year. It's recovered somewhat since, but is still down by over half on previous years. Now, some of this may reflect spending shifting within the same stores to contactless, but it's also likely to reflect a shift online. And you can see that spending on online-only retailers, so think like Amazon or ASOS, that sort of retailer, has risen dramatically since the lockdown began, up 60 to 80%, and it's stayed up over 50% since then. So there's clearly been a shift towards online retail as opposed to physical retail, but this could have important consequences since local shops may lose out and the money may drain out of local economies when this occurs. So we now turn quickly to look at how trends have varied across the country. There's a lot more detail in this in the actual report, but I'll just show some key trends here. So these lines show spending normalized to the January to February average of this year, which is different to the previous graph, for England, Scotland and Wales. And you can see that up to and including September, there was very little difference between the different nations in terms of how spending had changed relative to what it was like before the lockdown began. However, some important differences emerged in October and November, just as policy between the different nations begins to diverge. So during October, Wales held its circuit breaker lockdown, and it can be seen here that spending in Wales did indeed fall more than in England and Scotland during October. However, as restrictions began to ease in Wales, and in November they came out of their circuit breaker lockdown, spending rose again, whereas England, which went into a national lockdown, didn't see such a dramatic increase as Scotland and Wales both see. It's interesting also to look at how spending in London compares here. Spending in London is much lower than the rest of England and Scotland and Wales. It fell by more during the lockdown and has not recovered as well since. This is consistent with other findings in our report, which suggest that higher paid areas have generally seen lower spending and less of a recovery than lower paid areas. This might be reflective of higher paid areas seeing more spending on things like hospitality and experiences that were shut down during the pandemic. But this does mean that geographic inequalities in spending, at least, appear to have reduced a bit during the crisis, although this may be different going forwards, as we'll explore later. An interesting finding from one of our earlier reports is that local case prevalence itself does not seem to affect spending. So this chart here shows the relationship between an additional case of COVID-19 per 100,000 residents and spending. We can see that although very early on in the crisis, higher cases were associated with lower spending, that relationship has since disappeared, although our data does only go up to the end of September. Now, it's possible that people respond to national cases, even if they don't respond to local cases. And it's also possible that if we were to move into October and November with this, then as local restrictions become more common, these will be driven by cases, and so a relationship may appear. However, what this does show is that when policy is broadly consistent across areas, higher cases don't seem to lead to lower spending in a local area. Perhaps people aren't aware of cases in the local area, or they're only really bothered about national cases when thinking about spending. However, we do find that local restrictions have important impacts. So what we do here is look at how varying local restrictions relative to a baseline of just social distancing measures relate to spending. We look at three types of additional restrictions. The first is restrictions on hospitality, but not closures. So households cannot mix indoors, for example, which is analogous to the current tier 2 in England and some of the Scottish tiers as well. Alternatively, we look at the closure of hospitality. So this is tier 3 in England, which London has just moved into. And this is analogous to similar tiers in Scotland. And then finally, we look at the closure of hospitality and non-essential retail. This would be the same as the second English lockdown, the Welsh circuit breaker of October, and I guess also the restrictions that will be coming in soon in Wales. So understanding the impact that these things have on spending in an area is important when guiding how much support is given to local areas to deal with these issues. So the interesting finding is that apart from the first restriction just on restrictions on hospitality does have an impact on hospitality spending, as you'd expect, but doesn't really have any impacts elsewhere on total spending. So I'm not going to show that here. But here I do show the impact of hospitality closing. So this shows the impact from moving from social distancing to hospitality being closed on spending, first of all, in restaurants and pubs and other businesses in the hospitality sector. Spending here is shown here to fall by £3 or more per user per week in these sectors when you close hospitality. And the whisker plot at the end shows the error bars. So this is the range within which the true value could be based on our estimations. So somewhere between £3 and £4 is the effect you see here. However, interestingly, in most other areas, you don't see a big impact from closing hospitality. Perhaps you'd expect this given it's only hospitality closed. You see a small decline in transport spending, perhaps as people travel less to hospitality areas. Interestingly, you don't see a big increase in takeaway spending, at least as we're measuring it through the main takeaway providers such as Deliveroo, Uber Eats and Just Eats. However, we do see a rise in spending on online alternatives on websites like Amazon or ASOS. This possibly suggests that when people can't go to the restaurant or the pub, they instead use some of that money and buy more goods for themselves, perhaps books or other things to entertain themselves with. And the overall effect, therefore, of hospitality closing is around zero in total spending. However, it is important to note that while spending on restaurants and pubs will stay in the local area, spending on these online alternatives is likely to drain out of the local economy. So local areas are still likely to need support. Then these yellow bars show the impact of closing both hospitality and non-essential retail relative to a baseline of social distancing. The impact on hospitality is very similar, but there's a much larger impact on clothing, since those shops are mostly closed, and also the other category, which may include many other areas of non-essential retail, sees a decline. There's a big decline in cash spending, reflecting lower spending in stores, and transport spending falls by a lot more than the earlier restriction, I guess because people won't be travelling to go shopping because the shops are all closed. Interestingly, we see a rise in spending in groceries. Since we're measuring this as supermarkets, this could reflect people spending on things in supermarkets that you would otherwise buy in what's classed as non-essential retail. And online alternatives sees an even bigger increase. And so the issue of money draining out of the local economy is likely even greater. Also, when you add these up, we do see a decline in spending caused by closing hospitality and non-essential retail. It is not fully made up for by people substituting to online spending or to supermarkets. And so areas subject to these sorts of restrictions may be in need of even greater additional support. Finally, we just look at the issue of forced saving during the first lockdown. So this is reflecting the idea that there are many areas in which households would usually spend but were unable to spend during the first lockdown. And if they couldn't substitute to spending elsewhere, which appeared to be the case, they may just have to save more, which will have important implications for wealth inequality going forwards in particular, and possibly how much disposable income people have to spend in any recovery phase next year. So this first line shows the change in spending on areas considered less affected by the pandemic. So these are like groceries, takeaways, online alternatives. And we see that spending rose in these areas across the income distribution, with the poorest households on the left and the richest households on the right by income. This is expected and consistent with what we saw earlier. What we also see is that there's a big decline in spending in areas more affected, but this is much higher for the richer households. They perhaps reduce spending by £200 per month on these areas compared to less than £75 for the poorest households. When you add in cash spending as well, which also declined by more for the richest, you see that overall the richest two income groups generally reduce spending by much more than the poorest income groups. And this is true also as a percentage of income. What this means is that, a percentage of spending even, what this also means is that the richest are likely to have accumulated more savings during the crisis, subject to what happened to their incomes. And this means that going forwards, they probably will accumulate more wealth and may be better able to spend more once the pandemic ends. This has important implications going forwards for the distribution of wealth and possibly income as well, if wealth leads to greater income generation. So in conclusion, the first and lasting lockdown, as we saw, had a much larger effect on overall spending than subsequent restrictions have. And some changes in patterns of spending seem quite persistent. This suggests that consumers are substituting into other areas of spending, and businesses and consumers have adapted to the pandemic. Areas that saw higher spending pre-crisis have generally recovered less well, and so geographical inequalities in spending might have fallen, although this might reverse if, as we've seen, wealthier households are able to spend more after the crisis because they've saved during the crisis. Local COVID case rates don't seem to have a large impact on spending, but local policies and restrictions do have important impacts on the pattern of spending and, in some cases, the level of spending. And government needs to take this into account when designing the policies of support for local areas. So that's all from me. So I think we're opening to questions now. So thank you for listening.
Well, thank you very much indeed to Isaac and Alex. Quite a lot to chew on there. We're also joined by my colleague Tom Waters, and there's a couple of questions that have come up on Slido, but plenty more plenty more time for more if anyone has them. There's an interesting sort of philosophical question here almost from Alistair McQueen of Viva. Says that Isaac stated that reduced expenditure feeds through to reduced living standards, and he asks, is that true? Obviously, reduced expenditure may represent more saving. And I think it's an interesting question. I think the key point being that in the short run, if you want to spend and you can't, then you are worse off in the short run, but you may have more money going forward. So your living standards going forward may rise. But I think unquestionably, all of us felt that not being able to do the things we wanted to do meant that our living standards during lockdown were reduced, and that was because we couldn't make the spending. But Isaac, do you want to add anything to that?
No, I mean, I think that's right. I think this is one of the areas where it's important to, one of the reasons why we chose to create these control groups of individuals who look similar to the individuals receiving income through these income support schemes, but who don't see a hit to their income, because what it suggests is that for those groups, if they don't see a hit to their income, they don't choose to reduce their expenditure by as much. So it doesn't seem like all of that is just driven by people uniformly choosing to save more during this period. It does seem like if you see a hit to your income, and it may be that some of these individuals are choosing to save more because they're more uncertain about their future. Certainly you could see that in terms of furlough. But I think, as you say, Paul, even if some of this reduced expenditure is driven by saving, I think that what the evidence suggests is that this saving is largely not saving that these households would have undertaken if they hadn't seen their income affected or weren't so potentially uncertain about their future prospects. So I think, as you say, it's a behaviour that we wouldn't have seen otherwise, and therefore I think you have to see it as not as the first choice that these households would have made in a perfect world, if you like.
Absolutely. So there's an interesting question here about inflation, which actually possibly reflects some of the work colleagues at the IFS have done. Asks, has inflation been taken into account? So prices have gone up in grocery, so maybe the higher spending just represents higher prices rather than higher consumption. Is that something we've tried to control for, Alex or Tom?
Yep. So all the prices have been put into real terms in October 2020 prices from the October 2020 CPI release. And so for something like groceries, we've deflated that by the series for food and drink spend prices in the CPI. So it will reflect it to that extent. However, I think the work that other colleagues at IFS have done on grocery spending in particular has highlighted that currently CPI might not be measuring that well, because supermarkets have reduced multi-buy offers and that sort of thing, which I think may be behind a small part of the rise in the grocery spending, but it doesn't seem enough to justify the entire 20% increase in grocery spending that we saw.
Yeah, indeed, probably quite a small fraction of that. But yes, this is all in real terms. But what Alex says about other work we've done at IFS is quite revealing, I think, which is that the CPI does not take account of things like 2-for-1 offers. And we saw that across a range of supermarkets, those sorts of offers really collapsed through the lockdown period, and a different measure of grocery inflation that we could construct was considerably higher, actually, over that period than the measure that was recorded in the CPI at that time, though a lot of that has eased off over time. There's a question here about, as we really focused on the data, which is the problems encountered with getting the data. I mean, I don't know, maybe Tom, you'd like to talk about the provenance of the data, and then maybe Isaac, you could say something about the challenges of using it.
Yeah, so as Isaac explained, his presentation comes from this app, Money Dashboard, and we've been working with them to get a hold of this data. I mean, I think it's specific, particularly for this kind of situation where the world is changing rapidly, you know, every day and every week. That's where this kind of data is really useful, because we get it pretty much in real time. So have transactions with just a 1 day lag, and are able to kind of process them quite quickly and do analysis on them. So it's been, yeah, I think over the last 7 or 8 months has been a really exciting data source, which has definitely enabled us to talk about these patterns in a way that you're just completely unable to with a lot of the traditional data sources.
Sure. Yeah, I mean, in terms of some of the challenges that we've faced using the data, I mean, clearly one of the big challenges, as I sort of said in the presentation, is that these kind of data sources, we're not dealing with like an ONS data source where you have a random sample of the population, and so you immediately have a challenge as to thinking about how representative the group is. I mean, as I said, I think we found that actually once you make certain adjustments using weights and so on, in terms of age and region particularly, we think we get quite a representative sample in terms of income. I mean, there are obviously some other challenges associated with this kind of bank account data, particularly in terms of trying to work out if people maybe haven't linked in all their bank accounts. So you need to make sure you're looking for individuals who look like they have suspiciously low levels of spending and that kind of thing. And also there are some challenges associated with making sure you're capturing an entire household when you're looking at a user's constellation of bank accounts. But I think what Tom said is really important, which is that I think you need to look at these kind of data sources, particularly when time is of the essence, as I think it has been during the pandemic, and you have to think about what alternatives there are. And I think actually, in this case, there is a real value to using these slightly more unorthodox data sets to try and get this rapid information about how the pandemic is been affecting households in real time, and also about the efficacy and some of the issues associated with government policies that have been rolled out.
Yeah, I think that's terribly important. I mean, I think it's been very exciting using this data, and it has allowed us to do analyses very, very quickly on the basis of how people have actually changed their behaviour. So, for example, some of what you've seen presented today was looking at expenditure over November, and household sort of representative data sets tend to be many months, if not a year or more, out of date when it comes to looking at that kind of thing. Some more interesting questions here. One about universal credit. Maybe you'd like to take this one, Tom. The question is whether the analysis we've done suggests that there need to be changes to the 5-week wait.
Yeah, so just to remind people for the uninitiated, so the 5-week wait in universal credit is when you apply for universal credit and then you get your first payment about 5 weeks later if you're approved. You can get a loan, what the government calls an advance, to cover that period, although many people don't for a number of reasons. And certainly, yeah, the evidence which Isaac presented, which I think is some of really the first empirical evidence we have actually on people's finances during the 5-week wait, does seem to suggest that that's a period of difficulty with the people. You see their spending falling and then recovering somewhat after the money arrives. So it's clearly a difficult period for a lot of the people affected. I think for the government, kind of part of the key question is why some people not taking up the loans that are available. So they're loans on pretty generous terms, and in principle ought to allow people to kind of maintain a similar level of income throughout their time on UC. So I think that's kind of the key policy question. Why are people not taking up? Is there something the government can do to make these loans more salient or more attractive to those who really might need them?
Great, thank you. Was there, Alex, is there data on donations to charities? Is that something that you've been able to pick up?
So there's a category within the data that tags that, but it's very small, which makes it quite hard to look at. So it's not something we've actually looked at so far.
Right.
In data. So that I think I think charitable giving as a percentage of spending is very low, and also it might not be that well tagged, because a lot of the people you might give it to might be quite small organisations. So no, basically we haven't got anything on that.
So there's a question on whether we can see in this move from sort of spending on local shops to internet retailers. Is that something we can actually measure? I mean, can we see the extent to which there's been a shift towards online?
Yes, we can definitely see that. Yeah, there's this big shift online, and specifically to large online retailers, so Amazon, ASOS, but also things like eBay as well. So it's certainly some of those big online companies. It looks like there's quite a bit more spending than there have been before. It's much harder to measure the converse, what's happening to smaller companies, but I think it does. They kind of stand to reason that if you're in non-essential retail and for a large part of the last 9 months you've actually had to be closed, we would expect to see lower spending on those areas. And indeed, we do see that when non-essential retail is closed, spending on clothing or cash withdrawals as well falls. And so it does look like there's a shift away from physical stores towards online spending.
And did that continue over the summer when all of potentially most of the restrictions were gone? I mean, was there a sort of continuous effect that flowed through after the initial kind of big peak in the lockdown period?
So we do see that over the summer, clothing spending recovered very, very close to spending in 2019 for a lot of the summer. So clothing in particular is an area that saw a reasonably strong recovery. I think the other thing also that we see is that in the second lockdown in England in particular, where clothing shops were closed, so spending you'd think would fall to zero if everything being measured was spending in the clothing shops. Spending doesn't fall by as much as in the first lockdown, which suggests that even clothing stores that are both physical and online have managed to shift a lot more sales online even within that, and that wouldn't class as an online only retailer because of the way we've done that. So there's clear evidence even in the second lockdown that there's been a big shift towards online spending that's allowed sales to stay higher than they would have been if the stores had to completely close and you couldn't spend in that retailer.
But I guess the other question is the extent to which, I mean, there was a big shift to the big online retailers in the first lockdown. Did that continue through July, August, September to some extent, or did it go back to the sort of pre-lockdown levels?
Yeah, so it returns. So so spending was up like 60 to 80% on those big online retailers by the end of the first lockdown, and that kind of settled down at a more like up 50%. But it has definitely persisted since then, even as other businesses reopened.
So it settled down at 50% up.
Yeah, 40 to 50% up, that kind of level.
Okay, so there's a big persistent effect over the summer. It'd be rather interesting to see whether in a year's time there's a continued persistent effect, I guess.
Yeah.
Interesting. It feels like a slightly orthogonal question in some ways. Another one here from Alistair McQueen at Aviva, asking about whether the IFS is an advocate of a new wealth tax that I don't feel we can just let go by. I mean, we've done quite a lot of work on this, and Helen Miller and colleagues have published some work on possible cases for and against wealth taxes. I think the answer to that is it all depends what you mean to some extent by a wealth tax. Are you thinking of a sort of 1% tax once off on everybody, including on pensions and housing? And if you're not including, so if you're including pensions and housing, that's both difficult to administer and I think extraordinarily unpopular. If you're not including pensions and housing, then you miss most wealth, and it's also extraordinarily unfair if you happen to have saved for your retirement in something other than a pension or housing. Or are you thinking about something which is aimed at those with very high levels of wealth, or are you looking at something which impacts people on more or modest means, and those are very different sorts of taxes. I think our starting point would be that we have a bunch of wealth taxes which really don't work very well at the moment, and the first place to look is at making those work better. So, number one, we could have a council tax which actually taxes according to the value of your house today rather than regressively according to the value of your house 30 years ago, and that could act quite significantly as a tax on housing wealth. We have a capital gains tax, which is pretty hopeless, frankly, in the way that it works at the moment. It's pretty easy to drive a coach and horses through it with a combination of what was entrepreneurs relief and now business asset disposal or bad relief at death and so on. We have an inheritance tax, which doesn't work terribly well, and there are certainly plenty of ways in which that could be reformed. And we have, of course, a taxation of pensions, which is massively beneficial to particular groups through things like the tax-free lump sum and the failure to charge national insurance on pensions in payment. So I think there are lots of ways in which we could make wealth tax a lot better, which I think we would on the whole suggest one would try and do before introducing yet another wealth tax, which will probably work about as badly as the half dozen we already have. Let's move on to the issues more directly at hand. Then, having got that off my chest, I don't know what the answer to this one is. Is there anything you can say about holiday spending or spending on airlines or anything like that, or is that just too little of that in the data to say anything?
So in the original spending report that came out a couple of months ago, we have a category on holiday spending, which is comprised of effectively flights, package holidays, and hotels. So that, as you'd expect, plummets to very close to zero during the first lockdown, and then recovers somewhat over the rest of the year, but never more than it never gets anywhere near normal levels. That may be reflective. So hotels obviously include spending in the UK on hotels, so that may be reflective that people were doing staycations as opposed to going abroad. I haven't actually disaggregated whether it is spending on flights or hotels, but I think you can probably assume, given that the scope to go abroad this year is very limited, that a lot of that does reflect spending done in the UK this year.
Great, thank you. I'm not sure if this is right. Isaac, there's a question here about recipients of SAIS, suggesting that they didn't see their incomes impacted as much as furlough recipients. Is that right? And if it is, what do we think about that?
Yes, I mean that's right. It depends what counterfactual you imagine, right? So if you think of, the chart I showed you in the presentation was taking a very sort of almost quite simple-minded counterfactual of saying, well, if we assume that had they not received the furlough payments, the furloughed individual would just have been made unemployed, then yeah, their incomes, their household incomes would have fallen by a great deal, because for most households, the individual's jobs are the main source of income. For SAIS recipients, incomes have fallen less, and that's largely to do with the design of the policy. So if you're furloughed, you aren't allowed to continue working for the firm that furloughed you. If you're a recipient of SAIS, firstly, you simply need to state that you were your business activity was adversely impacted by the pandemic. What that actually means and how that's defined is not particularly clear. So there isn't really any obstacle to any self-employed individual making a claim on SAIS, even if really their income hasn't been particularly negatively affected. So that's the first thing. The second thing is that, unlike furloughed workers who aren't allowed to continue working for their employer while they're furloughed, if you're receiving SAIS, you are entirely entitled to continue whatever self-employed activity you were undertaking before. So many of these people will still have at least some portion of the income that they were earning prior to the crisis, and that's going to be supplemented by government support. So I think that difference in how much people's incomes have fallen prior to including the various kinds of support are largely down to the designs of the policies. I mean, the other thing to note, of course, is that some people who are receiving SAIS might also have employment income. It may be that self-employment income is the majority, but not all of their income.
Great. We're running towards the end. Anything more you can say about missed mortgage payments to explore what explains why so many of those have been missed?
I mean, I think my interpretation of the evidence, at least, is that a big part of this is just that. So, at the beginning of the crisis, the Financial Conduct Authority offered instructions to mortgage lenders to say that if someone requests a mortgage holiday over the course of the pandemic, they should be allowed to do so. They can take up to a 6-month mortgage holiday in 3-month chunks, I believe. And so I think a lot of the fact that we're seeing this activity on the margin of mortgages is just that it's become a lot easier to receive a mortgage holiday. I mean, it's not quite no questions asked, but it's a lot closer to that than it used to be. And so it may also just be, I mean, as we saw, some of our control groups who didn't see a hit to their income do seem to have stopped making mortgage payments, presumably by taking up a mortgage holiday. So it does seem like there are some number of households who feel like they would like to pause their mortgage payments for whatever reason. I mean, it's worth noting these aren't a free lunch. I mean, you do continue to accrue interest payments, so interest on your mortgage even while the payments are paused. So it's not necessarily a good idea for everybody, but some people have clearly decided that it is in their best financial interest, and that might also be to do with people's expectations about the future. People may be worried and feel like they need to and feel like they need more ready money than they did at a previous time.
I just add that. I mean, what we see is people who seem to not have much change in their income, as Isaac's saying, pretty significant fraction of them often paying their mortgage premiums through a mortgage holiday. And I believe that's consistent with survey evidence as well, that people who report no change in their income, a fairly significant fraction of them have nonetheless taken out a mortgage holiday. So it does look like, at least for some people, it's this extra kind of form of liquidity. You have a few months where you don't have to make the mortgage payment. You have a bit more cash in the bank account that you can use for something else.
Thank you. Well, we're coming to the end. I'm going to have to answer the last question here. It says, if the IFS are making normative recommendations based on this research, should they seek better gender representation among their researchers and presenters? To which my answer is, I think we are probably the only major economics-based organisation in the country, and possibly even in the world, which is completely gender balanced, including at the most senior levels, at deputy director and associate director level, and among our research staff. And indeed, the last time we measured it, we had a negative gender pay gap. We select people to do the research and present based on who is best placed to do that, not based on their gender, and we'd be just as likely to have an all-female as an all-male lineup. So I'm actually extraordinarily proud of our record on that particular issue. Thank you to my all-male panel for that fantastic set of presentations. Thank you particularly again to the Standard Life Foundation and also to Trust for London for funding that. And thank you all for making the time so close to Christmas for listening to us. Thank you.